Welcome back to the Deep Dive, your shortcut to being well-informed. I'm genuinely excited about today's topic, actually, because it tackles something, a problem many of us face looking at company financials. We're diving deep into IFRS 18. That's the International Accounting Standard on Presentation and Disclosure in Financial Statements.
Yeah, it's a big one.
It really is. Issued by the IASB, the International Accounting Standards Board, just back in April 2024. And it replaces IAS 1, which, well, that was pretty fundamental.
It's absolutely foundational.
So our mission today is to sort of cut through the complexity. We want to pull out the most important nuggets from IFRS 18, just so you get a really clear understanding of what it means for how financial info is presented. Ultimately, it's about making it easier for you to compare companies.
And the sheer scale of the impact here, it's quite striking. Companies used to have a fair bit of flexibility, maybe too much, in how they presented their performance. Imagine trying to compare, say, two companies in the same sector under the old rules. One might invest heavily in properties, another purely focused on operations. Their P&Ls could look wildly different.
Right, even if the underlying business was similar.
Exactly. This new standard, IFRS 18, it aims to cut through that noise, make it far clearer, far easier for anyone reading financial statements to compare apples with apples. And it's not just academic, not just for people studying for exams like SBR.
No, this is real-world stuff.
It's about real-world transparency, yes.
Okay, so if IFRS 18 is making such a significant splash, where does it start? Where does it fundamentally reshape how we see a company's performance? What's the biggest shift in the profit or loss statement?
Well, the most significant change, really the foundation, is the introduction of 5 mandatory categories for the statement of profit or loss.
5 categories.
Okay,
what are they?
They are operating, investing, financing, income taxes, and discontinued operations.
Got it. Operating, investing, financing, income taxes, discontinued ops.
Exactly. And think of the operating category as the main stage. It's for the company's core business performance. It's basically the default bucket for anything that doesn't have a very specific home elsewhere.
So to give a clearer picture of the day-to-day stuff.
Precisely. The everyday ins and outs of their main operations. Then you've got the income taxes category. That's specifically for how a company accounts for its taxes, following IAS 12.
The income taxes standard.
Yes. And the discontinued operations category, that deals with income and expenses from parts of the business the company has decided to stop. That follows IFRS 5.
Which handles assets held for sale and disco ops.
Correct.
So operating, tax, discontinued ops seem fairly straightforward. But here's where it gets interesting for me. The investing category. How does IFRS 18 clarify investment activities?
Yeah.
What specifically goes in there now?
Right, the investing category. This is where you'll find income and expenses from investments in associates, joint ventures, unconsolidated subsidiaries too. It also covers cash and cash equivalents, and importantly, any other assets that generate a return individually, kind of independently of the main business resources.
Like what kinds of assets?
Think debt or equity investments, investment properties, things like that. So say a company gets interest or dividends from those investments, or rental income from an investment property, or records depreciation on it, or has gains or losses from selling or revaluing those properties, all that now clearly falls into the investing bucket.
So it separates out the returns from financial holdings or properties from the main operational stuff.
Exactly. It draws a clearer line.
That distinction sounds really helpful. So we've covered core ops and investments, but every company needs funding. How does IFRS 18 bring clarity to the how? To what's really a financing activity on the income statement, separate from, say, operational liabilities?
Good question. The financing category captures income and expenses from liabilities that exist solely for raising finance. That's the key word, solely.
Solely for raising finance, like
bank loans or issuing loan notes, standard financing instruments. So the interest expenses on these loans may be fair value gains or losses on certain liabilities designated that way, even dividends on shares if they're classified as liabilities. All that goes into financing.
Okay, that makes sense.
However, and this is a crucial distinction, income and expenses from liabilities not solely for raising finance, things like lease liabilities or decommissioning provisions or defined benefit pension liabilities.
Right, those aren't just about getting cash in the door.
Exactly, they're handled differently. For these, only the interest income and interest expenses, like the unwinding of discounting, go into the financing category. Other income and expenses from these types of liabilities, think current service costs from a pension plan, for instance, that they actually get classified in the operating category.
Oh, okay. So it highlights whether the liability is about funding or running the business.
Precisely. It separates the purpose.
That makes sense. Now, something that always feels like a bit of a wild card. Currency fluctuations. Foreign exchange differences. How does IFRS 18 handle those? Seems like it could easily blur the lines between these new categories.
Yeah, FX can be tricky. IFRS 18 clarifies this quite neatly, though. It says foreign exchange differences are included in the same category as the income and expenses from the items that gave rise to them in the first place.
Okay, so follow the source.
Essentially, yeah. So, for example, an FX gain or loss on a trade receivable that's part of normal business, right?
Operating.
So it would be presented in the operating category. Conversely, an FX gain or loss on a bank loan liability, well, that loan is for funding.
So that goes in financing.
Exactly. It mirrors the underlying item,
Yeah.
makes it much more intuitive.
That underlying logic helps. You mentioned main business activities earlier, MBAs. That sounds like it could really change how we see a company's core performance. Can you explain what these MBAs are and why they're so critical for classifying income and expenses, potentially shifting them around?
They're incredibly important, yes, because they can change the default classification. IFRS 18 introduces this concept of main business activities, or MBAs, and it specifically calls out two types. One is investing in particular types of assets like debt and equity investments or investment properties. The other is providing financing to customers.
Okay, investing or providing finance is your main gig.
Exactly. And here's the crucial impact. If an entity has one of these specified MBAs, then some income and expenses that would normally for another company go into investing or financing will now be classified in the operating category instead.
Whoa, okay, so it overrides the default.
It does. Think of it like this. If a property investment company's main business is investing in properties, then its rental income or gains on disposal aren't just other investments.
They're core operations for that company.
Precisely. They become operating income. It shifts how you immediately perceive their performance. Same for banks. If their main business is providing financing, then interest income from customer loans. And even the income or expenses on loans they take out specifically to provide that financing. That all goes into operating too.
That's a significant shift.
It really is. But there's an important exception here. Income and expenses from assets accounted for using the equity method, like investments in associates, they always stay in the investing category.
Always investing for associates, regardless of MBA.
Regardless of MBA, that's carved out.
Got it. Okay, what about derivatives? I've always found those a bit of a black box in financial statements sometimes. How do their gains and losses fit into these categories under IFRS 18? Does it clarify their purpose a bit more?
Derivatives, yeah, they often seem complex. IFRS 18 gives them a clearer home now, too.
Yeah.
If a derivative is being used specifically to hedge an identified risk, say a futures contract to lock in the price of raw materials for production.
Okay, a hedging instrument.
Right. Then any gains or losses from that contract will follow the item being hedged. So in that raw materials example, it would land in the operating category.
Matching cause and effect.
Exactly. So the financial outcome of the derivative sits alongside the operational activity it's managing. And interestingly, even derivatives that aren't explicitly used for identified risk management, maybe more speculative positions, they generally default to the operating category, too.
Barely. Even speculative ones.
Generally, yes. It gives a clearer view, perhaps, of financial plays happening outside the core investing or financing structures defined elsewhere.
Okay. So beyond these new categories, IFRS 18 also brings in some mandatory elements for the P&L itself, right? It's not just sorting, but how it's summarized. What are these new must-have subtotals?
That's correct. It's not just about the categories. IFRS 18 introduces new mandatory subtotals. These must always be presented in the statement of profit or loss.
Always. What are they?
They are operating profit or loss, then profit or loss before financing and income taxes, and finally, the bottom line, profit or loss. And it's critical these must always be shown, even if, for some unusual reason, two of them happen to be the same number.
So even if operating profit equals profit before financing and tax, you still show both lines.
You still show both lines. Mandatory.
Okay. What about things like gross profit or profit before tax? Are they gone?
They're not mandatory under IFRS 18, but, many companies will likely still present them. They often provide a useful structure that users are familiar with, so they're still allowed, just not required.
Right. This leads to a bigger question about detail. How much detail do companies need to show? What does IFRS 18 say about presenting expenses and about aggregating or disaggregating information? Getting that balance seems key for clarity.
It is key. Entities now need to classify and present expenses either by function, by nature, or they can use a mix of both.
Function like cost of sales, nature like depreciation.
Exactly, but if they use a mix, they need to be really clear with labeling. So a line item might say something like depreciation costs other than those included in cost of sales, just to avoid any confusion.
Makes sense. And the aggregation part, grouping things together.
The standard gives clear principles here. You aggregate items that share characteristics. For instance, grouping various admin activities, HR, IT, legal as administrative expenses is fine. They share that administrative function characteristic. Conversely, you must disaggregate, pull things out based on characteristics that are not shared.
Like what?
A classic example is goodwill impairment. That does not share characteristics with general admin costs, so you shouldn't just lump it into administrative expenses. It needs its own line or clear disclosure. This whole process is vital, so the statements give useful summaries, not just a confusing jumble of numbers.
I appreciate the push for clarity. And speaking of clarity, I've always found lines like other income or other expenses incredibly frustrating. They just don't tell you anything. Does IFRS 18 tackle this?
It does, quite directly. The standard recognizes that using terms like other income just isn't helpful. It lacks descriptive value for users.
Here.
So companies should now use terminology that actually describes the nature of the items or the characteristics they share, or they should specifically describe any material items included in that line.
So instead of other income,
You might see income from debt investments, for example. Much clearer. If a truly more informative word can't be found, then okay, maybe you describe it as accurately as possible, like other investing income. But the push is definitely away from just plain other.
good, more descriptive value. Okay, so what does all this structure and clarity mean for those adjusted profit figures, the ones companies sometimes release outside the formal financials, the non-GAAP or non-IFRS numbers? IFRS 18 must have something to say about those.
Absolutely. This is where management-defined performance measures, or MPMs, come in.
MPMs.
Yeah. An MPM is defined as a subtotal of income and expenses that a company uses in public communications. Think press releases, investor calls outside the formal financial statements. And it communicates management's view of the entity's overall performance, but importantly, it's not specifically required by IFRS itself.
Like an adjusted profit figure.
That's a classic example, yes.
Right.
An adjusted profit that maybe removes non-recurring items or restructuring costs. That would likely be an MPM.
Okay. What isn't an MPM then?
Good point. Subtotals of assets or liabilities don't qualify. Neither do cash flow measures like free cash flow. It's specifically about subtotals of income and expenses used publicly to show performance from management's perspective.
Got it. So if something is an MPM, what does IFRS 18 require?
This is critical. If a measure qualifies as an MPM, there are specific disclosure requirements. They must all be included in a single note within the financial statements.
The dedicated MPM note.
Exactly. And in that note, the company needs to describe what aspect of performance the MPM shows and why management thinks it's useful. They also need to clearly explain how it's calculated and, crucially, provide a reconciliation.
A reconciliation back to
the most directly comparable IFRS subtotal. So reconciling adjusted profit back to, say, profit before tax or operating profit. And this reconciliation has to show the income tax effects and the impact on non-controlling interests for each reconciling item.
So they have to show they're working, basically.
Yeah.
Explain exactly what they adjusted and why.
Precisely. It's designed to help you, the user, understand what that adjusted number really means and compare it more easily across different companies. It prevents MPMs from being a complete black box, like asking the chef for the recipe, not just the secret sauce.
That sounds like a big step towards transparency for those adjusted figures.
It is. And furthermore, if a company changes how it calculates an MPM or just stops disclosing it altogether, they have to explain the change and the reasons why. And if the calculation method changes, they generally need to restate the comparative information too, unless it's impracticable.
So you can track changes over time. No surprises.
Exactly. Comparability and transparency over time.
Okay, this standard seems to cast a really wide net then. It's reaching into other statements too. What specific ripple effects has IFRS 18 had on, say, the statement of cash flows?
Indeed, it does ripple outwards. There were consequential amendments to IAS 7, the Statement of Cash Flow Standard. Remember how companies using the indirect method for operating cash flow used to start their reconciliation with profit before tax?
Yeah, that was the starting point.
Well, now it starts with operating profit, that new mandatory subtotal from IFRS 18 we discussed.
So it connects directly to the new P&L structure.
Directly connects, yes. And the terminology's changed slightly too. What used to be called cash generated from operations is now termed cash from operating activities before income taxes.
Okay. And what about the adjustments in that reconciliation for non-cash items?
Key point here. Adjustments for non-cash items in this reconciliation should only be made if those items were included in the operating category on the P&L and therefore are part of that starting operating profit figure.
So if an item was investing or financing on the P&L,
then you wouldn't adjust for it in the operating cash flow reconciliation. For instance, depreciation on an investment property measured using the cost model that's an investing item now.
right?
Or gains losses on certain financial instruments if investing isn't an MBA. Those wouldn't require adjustment in the operating cash flow section. They simply don't relate to the operating cash generation.
That clarifies the reconciliation logic. Any other cash flow changes?
Yes. New mandatory classifications for interest and dividends. Dividends paid must now be presented as financing activities. No choice.
Dividends paid, financing. Got it.
For most companies, interest paid is also financing, and interest and dividends received are classified as investing activities. The important exception, again, circles back to those main business activities.
MBAs.
Right. For entities whose main business is investing in assets or providing financing like banks or investment firms, how they classify these interest and dividend flows in the cash flow statement actually refers back to how they were classified on the P&L.
So if interest received is operating on their P&L, because lending is their main business,
Then it's operating cash flow too. It reflects their core business across both statements.
this standard really does touch so many areas. Were there any other sort of significant consequential amendments? Did bits of other standards get moved around because of IFRS 18?
Yes, absolutely. Some really fundamental principles that used to live in IAS 1.
The old presentation standard.
Exactly. Things like the going concern assumption, accruals accounting, the concept of fair presentation, rules around accounting policy disclosures, and disclosures about estimation uncertainty.
Core accounting concept.
Very core. They've actually been moved over to IAS 8. And IAS 8 itself has been renamed slightly to Basis of Preparation of Financial Statements.
So consolidating those overarching principles into one place.
Seems to be the idea, yes. Consolidate the bedrock principles.
Wow. Okay, so IFRS 18 is truly far-reaching. We've covered a lot today. From that new categorical structure for the P&L, aiming to fix comparability issues,
Right, the 5 categories.
to the mandatory subtotals, how main business activities completely changed the classification for some companies.
MBA impacting.
The push for clarity against vague terms like the new rules around management's adjusted figures, the MPMs,
The MPM note and reconciliation.
and even significant changes to how the statement of cash flows works and where fundamental principles now reside. It really is a comprehensive overhaul.
It absolutely is. And, this isn't just an academic exercise, as we said. These changes will fundamentally alter how financial performance is reported and hopefully how it's understood by users like you. The goal is definitely greater transparency and comparability. But of course, that relies on these new rules being understood and applied correctly by companies.
And interpreted correctly by readers.
And interpreted correctly by you, the reader. Exactly. Which I suppose raises an important question for everyone listening. With this new level of structured information, this clearer categorization, how will your approach to analyzing a company's financial health evolve? How might you use this differently?
That's a great question to ponder. How might these changes actually shape your understanding when you look at financial reports in the real world? How will you use this new structure to analyze performance going forward? Definitely something to think about. Thank you so much for joining us on this deep dive into the intricacies of IFRS 18. We encourage you to keep exploring these fascinating and important topics. We'll catch you on the next one.